It's the first major banking failure since the Great Financial Crisis. In just a span of 48 hours, the bank, once valued at $16 billion, that has been servicing tech, startups, and venture capital firms for many years, collapsed. It's causing panic among many. The long-term consequences are yet to be seen. This is the story of the fateful end of Silicon Valley Bank. Welcome to Chaos Theory, where we find the signal and the noise in all that's happening in tech. I'm Alex, your resident chaos coordinator. If you like content like this, be sure to subscribe and hit the bell icon. Now, let's begin. Everyone's felt the impact of inflation in the last couple of years since the pandemic. From gas prices to mortgage rates, things have gotten a lot more expensive. In order to curb inflation, the Federal Reserve has taken action with its most aggressive rate hiking campaign in the last 40 years. It's already caused pain in the stock market, as investors flee high growth but unprofitable companies and pursue quality and safety. However, it's now also hitting the banking sector. In one of the first dominoes to fall, crypto-linked Silvergate Bank announced that it will be closing amid several challenges in the crypto industry. But in this latest episode, the fallout has spread to one of tech's most beloved financial institutions, Silicon Valley Bank. So what happened? On Wednesday, March 8th, the CEO of SVB published a letter to shareholders saying that it was rebalancing its balance sheet by selling tens of billions of dollars of treasuries. They then announced that they would raise some money and sell some shares in SVB in order to raise $2.25 billion to shore up the balance sheet. The stock then dropped 60% on Thursday. Many VCs started emailing their founders, telling them to get their money out of SVB. What then followed was a classic run on the bank. Customers withdrew a staggering $42 billion of deposits by the end of Thursday. By the close of business that day, SVB had a negative cash balance of $958 million and failed to scrounge enough collateral from other sources. Trading was halted on Friday morning after the stock traded another 60% down in the pre-market. Finally, at noon on Friday, the FDIC shut down SVB. They said in a press release that insured depositors will have access to their money by Monday morning. That's only $250K. But the lion's share deposits held by SVB were uninsured. The FDIC said that they'll receive a dividend within a week covering an undetermined amount of their money and a receivership certificate for the remaining amount of their uninsured funds. It's basically what you would receive in bankruptcy, an IOU for funds that may not come back to you for weeks, if not months. The collapse of SVB is being called the worst since the 2008 financial crisis and COVID. It's a Lehman-sized extinction-level event. So how did this come to pass? Unlike other financial institutions that have imploded in recent times, SVB was actually a pretty financially solvent business. Here's how a bank makes money. Banks will take customer deposits and put them in long-duration investments like bonds and treasuries. Those long-duration investments generate yield and ultimately give them more money than the customers have deposited. The money that they make pays for operations and helps fund new products and services that the bank can offer. SVB itself offered many unique products and services tailor-made for venture capital and startup founders, like a banking service to startups and VCs, white glove services like mortgages for bankers, VCs, and founders, and loans to general partners who run venture capital firms who pledge their shares or carry interest in their VC firm. But if you take a look at their balance sheet, you'll see that out of $195 billion in what they owe, they had $208 billion in assets and customer deposits. That nets out to $13 billion in net book value. $91 billion of those securities are assets that they don't adjust on a quarterly basis. However, it's the $26 billion that they were forced to sell that triggered the panic. At any given point, if customers want their cash back, SVB could in theory easily cover that with 25% of their holdings. As long as customers don't withdraw more than that amount, it's fine. The problem is that if more customers ask for it, that triggers a run on the bank. Everyone rushes to be the first money out the door. SVB's issues started in 2021 when the bank received so many customer deposits so quickly that they were pushed to buy a lot of treasuries and mortgage-backed securities with long maturity dates. This was a sensible strategy in a low interest rate environment. But in 2022, everything changed. VCs were not investing as much money into startups, so there was a huge drop in total customer deposits. Startups were burning more money than they were raising. The bond portfolio, the assets that they have on the balance sheet, also declined in value as interest rates rose. Even their venture debt portfolio became distressed as VCs withdrew their commitments to keep funding startups. The challenge underlying all of this is what's known as the duration mismatch. What's the duration mismatch? Consider two jobs. One is offering you $100,000 a year and is paid out every 2 weeks, and another that's offering you $200,000 a year, but is paid out only once a year. Many of us would choose the former because the problem is that you still have bills to pay: rent, groceries, health expenses, and more. You need to match the timing of your cash flows with the needs that you have. At SVB, there was such a strong desire for profits driven by the substantial increase in their deposits, that they were willing to enter into what seemed like sensible, safe investments, like 10-year treasury bonds if it offered more than the near-zero rates that were so prevalent in 2021. However, this turned out to be a bad move as interest rates rose at their fastest rate in decades. What happens when interest rates go up so quickly? The underlying bonds that were paying 2% get devalued, especially now when you can get one that offers closer to 5%. If you hold these to maturity, there's no problem. You get all your money back. However, if you're forced to sell them, you have to sell it at a discount. Think like what happened in the movie Margin Call, where an investment bank during the great financial crisis had to unload assets quickly and thus affect the rest of the market. And it wasn't just in the bond market. Silicon Valley Bank also had challenges with their venture debt portfolio. Venture debt providers loan money to a startup and underwrite that risk based on what the current VCs of that startup say that they will do to support it in the future. It's just like when you have to ask your parents to co-sign something for you so that you can get an apartment in college. It's not based on the performance of the company or the assets they have, but by VCs being committed. In a bull market, the venture debt asset class has performed actually pretty well, averaging 18% a year, but that was a different time. If startups do well, venture debt providers like SVB receive warrants in the startup that can translate to equity that can have huge upside. However, if the startups fail, which most do, the banks don't get paid back. So how does all this impact you? In the last couple of days, we've seen a key part of the financial plumbing of Silicon Valley turn off. As a result, billions of dollars of customer deposits have been frozen. This means that people can't pay their bills or make payroll, access their deposits, and see their credit lines default. This affects small companies the most, not big tech. Companies with 10 to 100 employees will be hit hardest, which can have a very damaging effect on the startup and US economy. These little companies are what keep the US competitive versus the rest of the world. When customers see that their money was not safe at SVB, which was a firm in regulatory compliance, there will be panic and potential withdrawals. People are now asking the question, why would you keep your money anywhere but JP Morgan or a top-tier bank? Unless the Fed steps in, we'll see a contagion-like effect. What are the short-term consequences? If this drags on without a solution, founders and VCs will have a hard time making payroll. If companies aren't able to post payroll, this will have far-reaching effects not just in tech, but everywhere else. Many payment processing companies use SVB to store their capital, to move money around. If companies like Stripe can't process your payments, your mom and pop shop might be at risk. And the contagion effect. If what was once trusted can't be trusted no more, people will panic. The long-term consequences are yet to be seen, but if contagion does spread across startups, we'll see innovation drop in the US and the rest of the world. This could become the start of a lost decade. I know that the next few weeks are going to be tough. It might not seem fair. For founders looking to build the next big thing, or even a biotech upstart looking to create the next game-changing health treatment, you were all doing the right things. You had your money in the bank, and you were all about trying to figure out product market fit than trying to sell your product. Now, all of a sudden, because of another set of actors who couldn't properly manage risk, your company might now be in jeopardy. So what can you do? This can take a few weeks or months to get sorted out. A big bank can come in and rescue SVB and guarantee deposits on a one-to-one basis. Or the federal government can step in to warehouse the risk and guarantee the deposits to whichever company takes over the SVB portfolio, just like they did in 2008 in the great financial crisis. If you're a startup founder, prepare yourself. Focus on the things that you can control. Reach out to your VCs or institutions that can give you a monetary lifeline during this time. Be wary of predatory firms looking to try to capitalize on this moment. It's going to be a tough few months. Let's hope we can get through it together. Hey, thanks for watching. If you like videos like this, please give a thumbs up and subscribe, and leave a comment for what you'd like to see next. Until next time, to embracing the chaos together.